Welcome back to Let's Invest with ASX. In this video, we will be discussing initial public offerings, also known as floats. In order to buy and sell shares on the share market, they are initially issued by companies through a float or initial public offering (IPO). Whether purchasing shares in an IPO or on the market, the fundamental analysis principles and methods remain the same. The key difference is that for an IPO, the main source of information is the prospectus, and there is no historical share price or dividend data available. Product Disclosure Statement (PDS). Companies often use shares for listing on the ASX by preparing a PDS and lodging it with ASIC. A PDS must contain the information that investors and their advisors would require to make informed assessments, including details about rights, liabilities, financial position, and performance, as well as profits, losses, and prospects of the company that is issuing the security. Important questions to ask. Who is involved? This includes the stockbrokers, underwriters, management, board, or others. What is on offer? Determine whether the stocks are growth-oriented, income-yielding, tax-effective, or speculative. When does the issue take place? Consider whether it takes place during a bull or a bear market. Why are they raising funds? Determine whether it is for expansion, retiring debt, selling down, or attempting a takeover. How can you participate in the issue? Determine whether it's through a public pool, firm share, or entitlement. Who is involved? The PDS should outline the managers and directors of the company and disclose any financial interests they may have in the company. Vendor shares may be issued to existing owners and underwriters as payment for existing assets. Prospective investors should determine whether vendor shares are a fair and reasonable payment for the assets of the company. Constraints on the sale of vendor shares, known as escrow, should be noted. Shareholders should be aware of the escrow period and watch for any possible sales of vendor shares, which can be a danger period for the share price. Underwriters. An underwriter bears a risk or portion of risk in exchange for a fee or premium. If the public and institutions do not take up all the available shares on offer, the underwriter is obligated to take up what is left to ensure the company raising capital raises the money. Underwriters are typically stockbrokers or merchant bankers who are paid a fee for guaranteeing the issue, and this fee should be disclosed in the PDS. If the underwriter is left with unplaced shares, it can negatively affect the market as the shares overhang the normal course of daily trading. Underwriters generally attempt to place the shares as soon as possible since they are not long-term holders of shares. Company profile. A well-prepared PDS offers potential investors a clear and organized overview of a company's history, financial situation, and general operations. This is particularly helpful for investors who may not be familiar with the nature of a company's business operations. Board of Directors. When reviewing the list of board members in a PDS, investors should assess if they have prior involvement in failed or successful operations and evaluate the relevance of this information to the current company's activities. Why is the company raising funds? Share market activity is primarily motivated by the need for capital to fund various initiatives such as new inventions, mergers, acquisitions, or reducing liabilities. Before investing in a company's shares, it is essential to understand and be comfortable with the reasons for the company's decision to seek new capital. Pricing. Underwriters or corporate advisors may set a discounted price for an issue to ensure full subscription. This may allow for potential stag profits and a liquid secondary market. Additional incentives such as early dividend availability, franking credits, or high yields may also be offered to attract investors. No costs other than the purchase price of shares. Brokerage is only charged on trades performed on the secondary market. Firm stock. Firm stock refers to shares allocated to institutional investors and selected individuals before an IPO. These investors commit to purchasing a specific number of shares at a predetermined price. Firm stock helps ensure stable demand and provides early capital for the company going public. Deferred delivery settlement. Floats may list on the secondary market before share registry statements and HINs, holder identification number, are issued. If a float trades under deferred delivery, selling shares will not result in immediate settlement until the deferred date. Finding out about new floats. The ASX website lists all upcoming floats for companies that have lodged documents with the exchange. This information can be found under the Prices and Announcements tab on the ASX website's homepage. However, media reports may also mention upcoming floats that are not yet listed on the ASX website. It can be useful to monitor financial media and broker websites, as well as subscribing to newsletters, to stay informed about upcoming floats. Thank you for watching. We have prepared flashcards to help you test your learning. Make sure to check them out. Your support is greatly appreciated, so please consider liking and subscribing to our channel. By doing so, you'll help us create more valuable content for you. We look forward to seeing you in the next video.